Good morning. We will pay attention to inventory today, and we will pay attention to the different periodic and perpetual inventory systems, and also to the first in, first out, and weighted average. It's very important that you must know what is the difference between the perpetual and the periodic inventory system, because the accounting is done differently in the two different methods. Whenever a transaction occurs in the perpetual inventory system where you buy or sell inventory, it means that you will record it immediately in your trading stock account. So any entry increasing or decreasing my trading stock is recorded in the trading stock account. When you use the periodic system, you never have a trading stock account, so you don't use your trading stock account. The opening balance at the beginning of the year will remain in your stock account until the end of the year, and then you will move it to the trading statement. In the perpetual system, you will record all purchases in the trading stock account. In the periodic system, you record it in the purchases account. Okay, so we use a cost of sales account in the periodic system because every time when we sell goods, we decrease the trading stock to indicate that we have less stock, and we increase the cost of sales to increase our expense. In the periodic system, there is no cost of sales account. So what I will do at the end of the year, we will do a calculation to determine what is the value of the trading stock. Because we record all the entries in the perpetual system in the inventory account, it means that at any time during the year, I can balance my trading stock account to determine how much inventory is available in the business. At the end of the year, I will do an inventory count and determine if the actual inventory in the business equals the amount in the inventory account. So we will compare it with the balance in your trading stock account. That means if the balance is higher than the actual physical inventory count, we've got an inventory surplus. If the balance is lower, then it means that we have to write off trading stock and show that we've lost some money. In the periodic system, you never do a trading stock deficit or a loss of inventory due to fire or theft or whatever. In the periodic system, we have an inventory account at the beginning of the year. At the end of the year, we transfer that balance to the opening trading stock account. And then we will show that the closing balance according to the inventory account will be debited in the trading stock account, and we will credit the closing trading stock. So you can see there's a big difference between the two methods. I just want to show quickly why we don't do entry for the inventory loss. Say, for instance, we've got sales of 200,000. And our opening inventory was 20. We bought 60,000. And our closing inventory is 30,000. So now I can calculate my cost of sales. So 20 plus 60 gives me 80. 80 minus 30 is 50. So it means my cost of sales was 50,000. If I subtract my cost of sales from the sales, I made a profit of 150,000 rand. If we, for instance, change these figures, and I say that we had a fire or a burglary or some of the stock was lost, then I will still indicate that my sales are 200,000. My opening inventory will still be 20. My purchases will be 60. But now I've only got 10,000 closing inventory. So we've lost inventory during the year. Now if I calculate the cost of sales, 80 minus 10 gives me 70. So my cost of sales is 70. What do I see? We lost, if I look at this trading stock, we've lost 10,000. What happened to my cost of sales? The cost of sales increased. So the loss was 20, the cost of sales increased with 20. What will happen to my gross profit? My gross profit will decrease with the 20. So because we write down the actual inventory at the beginning and the end of the year, you never have to complete an entry for trading stock deficit. We call it that the cost of sales will automatically absorb the loss of inventory. So because we have less closing inventory, it means the cost of sales will increase with that amount and your profit will decrease with that amount. Okay, they quite often ask you what is the difference between the periodic and perpetual inventory system in the theory questions in the exam. So I'm just going to explain to you that as well. In the perpetual system, we have a trading stock account and a cost of sales account that we use the whole year. In the periodic system, we don't use a trading stock account and we don't have a cost of sales account at all. So we have a trading stock account, but we don't record anything in a trading stock until the end of the year. Cost of sales, there's no cost of sales account. We do a calculation at the end of the year. In the perpetual system, when I return goods, I will credit my inventory account and debit creditors control. In the periodic system, because we record purchases in a purchases account and we don't record it in the trading stock account, it means that when we return goods to the supplier, we will open a creditors allowances account because purchases is my expense and this creditors allowances will decrease that expense. In the perpetual system, both methods use a creditors allowances journal, but we don't use a creditors allowances account because we credit our inventory account. In the perpetual system, we record any trading stock deficit or loss. In the periodic system, we never record inventory loss. In the perpetual system, we can use this trading stock account and taking the balance in the trading stock account, we can determine at any time what is the value of our stock during the year. In the periodic system, the only way that you can determine how much stock you've got is by doing an actual inventory count. Okay, if we look at the different transactions during the year, I can see that if we purchase goods, in the perpetual we debit trading stock, in the periodic we debit purchases. If we buy goods on credit, trading stock is debited, purchases is debited. Okay, if we sell goods, in the perpetual system, we will do two entries, one at sales price and one at cost price. So I will show that the bank increased on the debit side, sales income increased on the credit side. For that entry, I will do exactly the same. But for the cost of sales, we have to create an expense to show how much what was the expense to be able to sell these goods, and we will credit trading stock to decrease the value of our trading stock. In the periodic system, we will not record the cost of sales. If we sell goods on credit, again, we will have to do one entry at sales price, one entry at cost price. For the sales, the two entries will be the same for both methods, but in the perpetual system, you will have to do a second entry for cost of sales and trading stock. If goods are returned to creditors, it means that the creditors, we owe less money now, so we will debit the creditors. We will credit trading stock because we have less stock and we want to decrease our balance in the trading stock account. In the periodic system, the creditors is debited, but now we credit creditors' allowances. So we use a purchasers account and a creditors' allowances account, where in the perpetual system, we will credit the trading stock account. Goods returned by debtors. Now, when we sell goods, whether we sell it for cash or credit, or when the debtors return goods, we have to do two entries. One entry at sales price, one at cost price. Debtors allowances decreases my sales, so it's an expense. I decrease my debtors on the credit side, and I'll do the same in periodic. But then I have to do a second entry to indicate that the goods was received back in the business, so the trading stock increased, and we credit cost of sales to decrease the cost of sales because now we're not selling it, so the expense decreased. If we donate goods, or the owner to take goods for its own purpose, or you take goods to use as stationery or for marketing, whatever, you will debit your expense account and you will credit trading stock. In the periodic system, you will credit your purchases because you want to show that the expense for purchases must decrease. If the owner takes goods, it means that we will debit drawings. We will indicate that this trading stock is decreased. In the periodic system, we want to decrease the expense for purchases. If you pay carriage on purchase or import duties or shipping fees, any expenses that you pay when you buy inventory forms part of the value of your trading stock. So to determine the cost price of trading stock, I take my purchase price plus any expenses that I pay from the time that I bought it until it's delivered to my premises. So any of those expenses will form part of the trading stock. In the periodic system, we will open separate expense accounts for carriage on purchases, import duties. Okay. If there's a trading stock deficit, we will debit the trading stock deficit and credit the trading stock. And in periodic, we will not record that at all. If I look at my trading stock account, I just want to show you that all the entries that have something to do with trading stock is recorded here. So if I look at cash payments, we bought goods. There we bought goods on credit. We return goods to the creditors. We sold goods for cash. We sold goods on credit. There the debtors return the goods. Then if we give goods as a donation, marketing, stationery to use in the business, and drawings, we will add to the credit side to indicate that the value of trading stock decreased. I will balance my trading stock account, and then I will look at the physical inventory count. So if this balance, this is the physical inventory count. If that is less than the amount that we get here, it means that I must add a trading stock deficit. So the difference between my actual inventory on hand and the balance in the trading stock will indicate if I've got an inventory deficit. So that means somewhere during the year, inventory was lost because it was broken or someone steal things or whatever. Say, for instance, your balance is more than the inventory count, then you've actually, in your balance, have less goods than what you actually have when you do the inventory count. Then you will have an inventory surplus on the debit side. The only time that you can have an inventory surplus is if there was a mistake in your accounting record. So you didn't record a source document, or for instance, there was a mistake in the calculation of cost of sales, because there can't suddenly be a lot of goods that you don't have in the business. So the only reason why you can have a trading stock surplus is if there's an admin mistake. Nothing else can cause that. On the last day of the financial year, when we determine whether the balance in our account, trading stock account, and the actual inventory count compares, we will do an entry in the journal and ledger to indicate that there's an inventory deficit, that's an expense that will decrease my profits, and I will decrease this inventory here. So what's very important is that you must remember that the balance that you have in your trading stock account at the end of the year, that balance will go to your balance sheet. So it means that if the balance that you calculated in your trading stock account does not agree with the physical inventory count, you have to put in the balance of the physical inventory count here, because I can't show a figure in the balance sheet that's not accurate. And then I will determine whether there's an inventory deficit or an inventory surplus. In question 1, I gave you a lot of entries that can happen during the year, and I'm going to do this now so that you can see here. I'm not going to do all of them because it will take a lot of time, but this is a very good summary of what happens in your account when you use the perpetual and the periodic system. So anything to do with inventory will be different. So if I look at my trading stock account, when I buy goods, I debit my trading stock account. What do I do in the periodic system? I debit the purchases account. If we sell goods, we will credit the trading stock account because we have less goods. In the periodic, you will not record anything for cost of sales. If we return goods to creditors, the 20, you will record it in your creditors allowances journal to indicate that there was goods returned. Okay, then you will always have a cost of sales entry in your trading stock when you sell goods for cash, credit, or when goods are returned to the business. You will never record that in your accounts. So where we record everything in our trading stock account that is an asset, in the periodic system, we don't record anything in the trading stock account. We open these separate expense accounts. So the purchases, carriage, import duties, creditors, allowances. So it is treated as an expense. In my trading stock account, when I use the perpetual system, that balance is at the beginning of the year. I will not use my trading stock account the whole year. So at the end of the year, I take it out of the trading stock account and I transfer it to my opening trading stock account. Then this closes down. I do an inventory count. I determine that the physical inventory on hand is 186,500. Now I must go and create an asset because this asset amount must go to the balance sheet. And then it will remain in this account until the end of the next year. So this 186,500 I will transfer to a trading stock, closing stock account. Okay, when we do the trading account, it means that the first thing that I do is I will transfer this creditor's allowances to my purchases to indicate that it decreased my purchases. So the creditor's allowances I take from the creditor's allowances on the debit side and I transfer it to purchases. Then all these accounts, purchases, carriage, import, all those accounts are closed off to the trading account on the debit side, so that we have all the expenses for the inventory that we purchase on the debit side. I will close this opening inventory account and transfer it to my trading account. This closing inventory has a credit balance. I will close it on the debit side and transfer it to the credit side there. Then if I look at all these entries, I don't do an inventory loss, so I calculate the profit. In the perpetual system, we only transfer sales and cost of sales to the trading account. So it means then I calculate my profit. Now we see there's a difference between the profit in the trading account when we use the perpetual system and the periodic system. And that is due to this inventory loss. So the inventory loss is transferred to the profit and loss account. And now if I subtract it, I also get the same profit. So although your gross profit will be different with 3,500, your net profit in both exercises will be exactly the same. You can do this in this periodic inventory system to see how it works when you take it to the different accounts. I'm not going to do all of them. I'm just going to do the ones that's normally difficult for you. So if I look at the trading stock account, the balance is 120,000. So I will start my trading stock account with a balance of 120,000. Okay, at the end of the year, I will close this trading stock account so that there's no balance left over, and I will transfer that to the trading account so that I can determine the gross profit that we made. So I will credit trading stock and I will debit my trading account. And that will be my opening inventory. Okay, if we look at the sales, there's credit sales of 388,800. And then if I look at the credit note issued for goods returned is 18. So my sales was actually decreased with 18,000. So I will show my sales in the trading account, and I will take the 388,800 that I transfer from my sales account, and I will subtract the 18,000 debtors allowances, and that will give me 370,800. So here I'm not doing all the accounts. I take it as if they give it to me the end of the year, what will I do then? Okay, here we have an invoice received for credit purchases, and there's a credit note. So it means that my purchases decreases with 20,000. So I will take my purchases account to the trading account, and I will show that the purchases was 260,000, but of that 260,000, we returned 20,000, and that gives me a purchases amount of 240,000. Then I will look at any expenses that we paid, and there was carriage on purchases and import tax. So it means that I will transfer those two expenses, carriage on purchases, because it forms part of the cost price. of the goods when we have expenses to get it to our premises, 12,000, and import duties, is 24,000. Okay, then I will look at my opening inventory. I took it to my trading account and I closed that off. And then I can look at my trading stock at the end of the year, and now I have to show that we create an asset again, because this amount must go to my balance sheet. So trading stock is an asset. So if I have any trading stock left over at the end of the year, I will take it to my closing inventory account. And I will credit my closing inventory with the 186,500. And then, because opening inventory and closing inventory is a nominal account, I have to close it and I have to take it to my trading account. And this is my closing inventory. Okay, now you can take a shortcut. That's what I did with opening inventory. I didn't take the amount to the opening trading stock account and transferred it from there to here. So the long method is to close the account, take it to trading stock, then close this account and take it to trading account. The short method is if you just close it and you take it directly to your trading account. Both methods are correct. I like to explain this one with the two accounts so that you can just understand that we actually create nominal accounts that we transfer to our trading account to determine the profit. Okay, if we look at our trading stock account and we look at the entries that we will record for that same exercise, the opening balance is 120,000. So I will have a balance here at the beginning of the year of 120,000 rand. Then I will record the amount that we bought. Okay, invoice issued for credit sales. So first of all, we sell goods. So it means that I have to show that my trading stock decreases, and I will debit my cost of sales to see what was the expense to sell the goods. And in this exercise, they said that we make a profit of 80%. So it's 800 times 100 over 180. And that will give me 216,000. Okay, if I look at the credit note, was 18,000 that we issued. So the goods came back into the business. So I have to show that my trading stock account is debited. And I will show here cost of sales. And I will take the 18,000 times 100 over 180, because I have to show the cost price in my trading stock account, and that will give me 10,000 rand. So remember, any amount in your trading stock must be at cost price. Okay, then we invoice received for credit purchases 260. So we will debit our trading stock account to indicate that the trading stock increased. We bought it on credit. So the creditor's control account will be credited. Okay, then we issue a credit note. We receive a credit note for goods that we returned the 20,000. So I will decrease my trading stock because we send goods back. So we've got less trading stock in the business. And I will debit my creditors control account to indicate that the creditors balance will decrease because we owe them less money. Then these expenses that we paid will now go in your trading stock account, and I will show the 12,000 and the 24,000. And we receive invoices, so the creditors control account will be credited. Okay, then there's still one entry, and that is that our trading stock is 186,500. So it means that I must put in the new balance, and the balance in your trading stock account at the end of the year will also always be the physical inventory count. So I have to add up the amounts on the debit side, and I get the total of 426,000. Then I subtract all three of these figures on the credit side, and I see there's a difference of 3,500. So that means this is inventory that was stolen or lost or broken during the year, and that is a loss or expense for the business. So I will write off trading stock deficit. And I will debit my trading stock deficit account to indicate that we create an expense that will decrease my profits with 3,500. Okay, if we do the trading account in the perpetual inventory system, we will take the sales to the trading account. So it means that I will take now the sales price, and invoices issued was 388,000. So that is the amount that will go to the sales. And then there's 18 return, so I must subtract the 18. So to determine what was my total sales after the returns, I will take the sales figure and I will subtract the returns of 18,000. So my total income for the year was 370,800. Okay, then I will look at my cost of sales, and I will transfer the cost of sales. Okay, so what do we see here? There was a cost of sales of 216, and there's a cost of sales of 10 for goods returned. So it means my expense is the 216 minus the 10,000, and that gives me 206,000. If I subtract the two from each other, I can take to my profit and loss. My gross profit is 164,800. And I will transfer that profit to the profit and loss account. So I will indicate that the amount that came from the trading account is my gross profit, and it will start with 164,800. Then I will write all my other income and expenses in the profit and loss account to determine the net profit in the end. Okay, here's an inventory deficit. So I just want us to do a question together again. Okay, my sales is 42,000. My trading stock at the beginning of the year is 6,000. Purchases is 42,000, and there is trading stock that was taken by the owner, so it means it decreases my purchases. So my purchases, total amount that we bought for expense was 42. Because the owner took goods for his own use or we give it as a donation, it decreases this expense, so the purchase is actually 40,000. Then there's carriage on purchases and import duties. That forms part of the cost price. I will also indicate that in my trading statement. And then the closing stock is 28,500. So I will be able to calculate my cost of sales, adding these figures together, subtract the 28,500, and that gives me 25,500. And if I subtract that, it gives me a gross profit of 16,500. If we, for instance, do an adjustment where we say that there was stock stolen or there was a fire, after we've done the closing inventory, then it means my sales will still be 42,000. The opening inventory is still the 643.5, but now there was inventory destroyed for 6,000, so it means of that 28,500 that we calculated in the inventory count, 6,000 was destroyed in a fire on the last day. So now our inventory is only 22,500. So what will happen now? If I do this calculation in this case, the cost of sales will be 31,500. So what happened? Because we've lost inventory, we decreased the closing inventory, and the result is that the cost of sales increased with that 6 rand. If we look at our gross profit, we will see that the gross profit between the one that we calculated without the fire and with the fire changed with 6,000. So it means if there is a fire or a burglary or just normal goods damage, your closing inventory will automatically decrease in the periodic system. That's why you don't have to do an inventory deficit, because the amount that was lost will automatically be absorbed by the cost of sales, because it will increase automatically and decrease your gross profit. Okay, then there's one question that I put in here that they sometimes ask in an exam paper. So they don't give you the closing inventory. They tell you for some reason they couldn't do an inventory count. So it means that we will show the sales as 90,000. Now, because there was no inventory count, we have to use our profit percentage to calculate the cost of sales. So I will take the 90,000 times, they say I make a profit of 50% on costs, so it's 100 over 150, so my cost of sales must be 60,000. Okay, my opening inventory is 20,000. The purchases is the 58,000 minus the one that was donated. So the purchases is 57,000. And now by balancing, we have to calculate what is the closing inventory. Okay, if you're unsure how to do this, just think what I normally do. I will say the opening inventory, 20,000, plus the purchases, 57,000, minus the closing inventory will give me 60,000. Then you do a mathematical increase and you say, okay, the closing inventory will go to the other side, then it will be positive. The 60,000 will come to this side, then it will be negative. So it means I take the 20 plus the 57 minus the 60 to determine what is my closing inventory. And that gives me then 17,000 Rand. And I have a gross profit of 30,000. So what I want you to do is do some of these questions again, just to make sure that you understand what you are doing. This is very important. There's always questions on inventory in the exam. And if you don't know how to do it, you actually lose a lot of marks. To shorten the video, I'm just going to stop here and I'm going to record a second video on the rest of this chapter.